what we're looking for in changes or market directions, for starters, I use a pivot point and a 3-period pivot point to help identify changes in the condition of the market. For example, if the pivot point is above the 3-period pivot point moving average, the market is also, and the market closes above the values, then we are considered to be in a bullish environment. If we are bullish, so let me draw this. So if the market actually, if it opens here and closes there, if this closed assigned value is above the pivot point and above the 3-period pivot point average, the market's considered bullish. So I want to be looking for buy signals near support. So if the market comes back and tests the support, if the market comes back and tests the support, if the market comes back and tests the support, and then again, our values are starting to do what? Develop into a uptrend with higher highs and higher lows. And that is something that we determine by looking at a true typical price moving average, not just a closing moving average. We want to be looking at a true typical price against, which is the pivot point, against a typical price moving average, which is the 3-period pivot point average. And that'll help give you at least an idea that there is a conditional change, or in this case, as we see, a bullish conditional change occurring. Now, I've introduced you to pivot points. I've introduced you to how you can identify the bullish or bearish condition. This is pretty advanced material here. I know the course started off slow, introducing you to Forex and comparing against futures, and all of a sudden we're into major mathematical advanced studies. But really, if you think about it, this is simple. But it's just so simple, no one really thinks about it, except for some very large, well-funded hedge funds and commercial traders. And I know for a fact, because I've actually taught a few hedge fund managers who have in excess of over $100 million this method, and they use it effectively. And at other managed fund conferences, I've discussed using a system similar to this with other very prominent traders. And I can tell you right now, a lot of them use this methodology. They all might have different twists, quirks, and idiosyncrasies and tweaks, so to speak, or optimize different variations of a moving average approach. But they're all using, a lot of them use a pivot point moving average to give them a true reflection of the market price. And since we do see in foreign currency a lot of wide swings in the market, if you averaged out the high, the low, and the close of a given time period, you'll get a truer sense of the market, and therefore you'll have at least uncovered a better value or trend direction of the market. Remember I said that pivots can help us identify the trend condition of the market? Well, here's a great example why. Now, when we go through trending market, or phases as I call them, the market goes through several different phases. For one, we're going to see the market go from a trend phase, and then sometimes we go through consolidation, and the market either reverses the trend, or sometimes the market can resume the trend. And in this situation, wouldn't this look like kind of like a bear flag in the marketplace? But a lot of times we don't know which way the market's going to break out, and you develop what's called these sideways channels in the market. Well, if you use the typical price methodology, sometimes you will see that the moving average slopes upward, and that may give you a hint that the breakout is going to be to the upside rather than the downside. And so therefore you want to look for buy signals near support, and look for and take the buy signal breakouts a little more effectively, meaning don't disregard them. So if you have a moving average that can represent the true typical price, it's going to help you determine the true value of the market a little easier. Now, let's take a look at this, which is our chart. We're using, this is the Japanese yen against the US dollar, and this is a high-low close divided by 3 average against a 1 period high-low close divided by 3, which is our pivot point. So all we're doing is using our pivot point versus our 3 period average of the pivot point. And what I'm looking for is if the shorter term crosses, as I demonstrated earlier, remember that, and we have this type of crossover, right? And we have the market crossover, which it does right here,